Hey everyone, welcome in to a daily editorial here on the KE Report special Easter Monday daily editorial as I am chatting with John Rubino. You can follow John on his Substack. And John and I are going to be talking a fair bit about precious metals as well as the underlying stocks, some of which have started to move. We'll talk more broadly, but also mention a couple names that John is watching. John, first note that you sent over to me today, though, dealt with the Fed, asking the question, did the Fed just capitulate by promising rate cuts this year while inflation is still above their 2% target? This brings up more of this theme here where the Fed is and other central banks starting to look at rate cuts even before inflation has gotten down to those 2% targets. However, inflation has moderated a lot from some of the numbers we saw last year. So, John, how do you balance the messaging from central banks, including the Fed, on rate cuts and projecting them this year while also admitting that inflation, they're not expecting it to get down to that 2% target this year or even next year?
Hey Corey, yeah, this is potentially really big news because U.S. inflation is, depending on the measure that you use, 3% to 6%, and it's the core numbers, which are usually the more reliable ones, that are higher. So a situation like that would normally be, in other words, 1 or 2 percentage points over the Fed's inflation target. That would normally be a signal to tighten. But I think the Fed is getting so much pressure right now to start easing again because there are lots of things under the surface that are happening that are scary. They're trying to calm the markets down by, first of all, predicting or promising interest rate cuts in the future, and then maybe pretty soon doing it. That is kind of a capitulation because there's no guarantee that inflation will keep going down and get below their 2% number. So they might be easing monetary policy in the face of 3 or 4% inflation that could just as easily go up once interest rates start going back down. So this is a very big deal for the world's currencies, because if you think 2% inflation is the ongoing normal, then okay, that's not super exciting or super scary. But if you think 4% inflation might be what we're looking forward to, then you as a player in the markets are liable to act accordingly, which is to bail on the currency, or at least convert a lot of whatever currency you're working in, euros or yen or dollars, into real assets. So we get that, that capital flow thing that we've been talking about for such a long time, where money starts flowing out of financial assets and into real assets. And that's kind of destabilizing for an over leveraged financial system. So that's what the Fed is risking right now, that the markets react to the possibility of ongoing 4% inflation. And they do it in a way that causes more inflation in the future. Inflationary expectations are what determines price levels going forward. And if we expect accelerating inflation, then we'll get it. So that's the kind of thing that could happen from what the Fed is doing right now.
So, John, what about the argument that, look, the inflation has come down and it is still trending a little bit lower, although it's almost flatlined recently with some of the data, but it is significantly under, at least from the Fed's data. It's about 2% difference broadly here from where the Fed's fund rate is to where inflation is. And the Fed is just talking about quarter point rate cuts. So could it be more of a testing the water, seeing what would happen if they do cut and seeing if inflation could keep moderating? It doesn't need to go down in a straight line, but if it does keep dropping while the Fed can moderate their policy?
Well, yeah, that's what they're doing right now. They're trying to figure out how the market's going to react to various possibilities. So you could call the promise of 3 rate cuts in 2024 a trial balloon to see what happens. And one thing that did happen since the Fed started talking like this is Bitcoin is soaring, gold is just rocking right now. And those are signals that the market is sending to the central banks of the world about what they expect going forward. And it's not reassuring from the point of view of a central bank, right? When you see safe haven assets start to go up at an accelerating rate, that's a sign, normally that's a sign to tighten. so they have some big problems here. See, now on the other side of this, you've got the commercial real estate implosion going on, and you've got stuff in the labor markets that are more disturbing than you would expect based on a 3.5 or 4% unemployment rate that we've got right now. So there are reasons to be worried about actual deflation too. So and you've got the election in the US. So the Fed has a lot of things to worry about. And normally when central banks are stressed out, they react with easier money. And I'm just saying that if they do that this time, they're running some big risks. And the market for safe haven assets are signaling what those risks might look like, because you don't want real assets to run out of control, because that is basically inflation in that sector. And the Fed is risking that right now. So how it turns out, because we got these deflationary things going on over here and we've got inflationary stuff over here, there's no way to know exactly how all of this plays out. But the tail risks in either direction are absolutely terrifying in a world with this much debt. So, my reaction to this is to be as cautious as possible and to own safe haven assets and avoid financial assets, just because the worst case scenarios in either direction are extremely bad right now.
Yeah, John, there is that risk that inflation keeps running. And to your point, if these commodities start running, that does also tie into inflation. But what do you take away from the environment, too, that it is risk assets also running? It's kind of everything that's running. Commodities are finally just starting to play catch up to all these other assets out there. Everything seems to be celebrating the potential of a rate cut. What happens if we only get, say, one this year? What do the markets do? What do commodities do in that environment?
Well, that's the question, because if they expect three cuts, if they expect a return to easy money and they don't get it, then today's valuations for instance, tech stocks are already crazy. It doesn't matter what monetary policy is going forward. This is not a good time to be owning those tech stocks based on history. Every time they've gotten to these valuation levels, there's been a massive crash that followed. So if they're disappointed, then you would expect a reaction in the major stock indexes in the US that would be really, really negative. And then you'd expect commodities to react that way too, because right now the markets seem to be expecting good times with a little bit of inflation. That seems to be what they're expecting in the next year or so, right? So that's why you've got stocks going up at the same time a lot of commodities are rising. Take that away, and then it'll be a bloodbath, to use a popular term lately in the U.S. And that's just one of the risks that you run if you're in a financial market where the major assets are this overvalued. Now, having said all that, when you talk about valuation, there's no comparison between equities, broadly speaking, equities, and commodities. Commodities, relative to the S&P 500, are at one of their lowest levels ever. So they're up a little bit in general. Oil is what, $82 a barrel right now, and gold is at an all-time high, and three or four other commodities are in pretty good shape right now. Uranium is way off their lows. So commodities have bounced back a little bit, but they're still relatively cheap. So they would be hurt less by a monetary policy disappointment than would equities. So I think, if you're an aggressive trader, shorting tech stocks and going long commodities would probably be a pretty good trade over the next couple of years. I'm not saying go out and do that, because it's also dangerous, but I think some people who do variations of that will probably do really well in the next couple of years.
Yeah, you do need to watch out for shorting those tech stocks, though, because boy, oh boy, that would have been a very big losing trade over the last little bit. Just been interesting to see. I've been watching the same chart, John, where we see the value of hard assets continue to drift lower against these markets. At least recently, it's been kind of flat where everything's been going up. But even recently, it was last year that the markets were pricing in multiple rate cuts. We didn't even get any last year, and the ones this year have been being pushed back, and markets are still going higher. So seems like it's just a party for the markets, which, again, it's nice to see commodities also joining in. Let's talk about the precious metals, stocks more so, because we are starting to see some of these companies respond to these higher prices. Especially, I've noticed the majors on higher volume, they have rebounded. Now, obviously, a lot of work to do to the upside, but What have you noticed in terms of precious metals, equities more recently, more just in the last month?
Corey, how long have you and I been saying that, oh, gold is around 2000? That should be great for the miners. Wait till these miners take off in response to higher gold prices. 3 years,
Yep,
it didn't happen.
absolutely. It was lower highs every time
Yeah,
we saw those.
yeah. And so now it's starting to happen. And this is just the last 5 days or so that it's been going on. But some of the blue chip royalty companies like Franco-Nevada and Royal Gold are up between 5 and 12 or so percent, and a lot of the big brand name miners are up too. So people are starting to move money into the precious metals miners. So we had to find out what price gold had to go to before the miners would start to respond, and it looks like 2,200 US per ounce is the range where gold needed to get to before it got people excited. So if it stays up there, then that's good news for the miners because I think there's a tremendous amount of cash on the sidelines or that's coming out of other sectors as people take profits in, for instance, tech stocks or cryptos that could easily flow into the gold and silver miners. So, there's no guarantee gold holds 2050 or wherever it is right now. But if it does, or Lord willing, it goes up from here, then I think the miners ought to respond pretty strongly to that. So a lot of these, and just because they've had 12% gain in the last 5 days, doesn't really mean they're overvalued yet. They're still ridiculously cheap compared to the overall market and compared to their recent highs. So there's a long way to run for the highest quality gold and silver miners if gold just cooperates.
Oh, John, gold's at 2250 right now, and in all fairness, these stocks did start to bounce even at the beginning of March. You look at something like Newmont, that's up over 20% just since that early March low that was put in. But again, you look at some of those longer term charts, boy, oh boy, these stocks have a long way to go and a lot of resistance levels to overcome. You mentioned that kind of waiting for some of the money to rotate out of other sectors into the precious metals. You've already mentioned tech a number of times as being overvalued. Is that a key area that you're watching, or where else do you think, if we saw weakness in whatever sector it might be, that money would then flow into the gold or silver miners?
Well, Corey, a couple of things. One, the stocks I'm watching, it really has just been a week that they've really been moving. A lot of them were just languishing. And I think Newmont had such a horrendous earnings report last time around that could be a factor that it moved a little sooner because it bounced off the bottom. But anyhow, I think there are lots of sectors out there where money could be flowing out right now, and real estate is a big one. Because if you've got some profits in pretty much any kind of real estate, and now interest rates are up, parts of the real estate sector are really getting beaten up. You might be nervous. If you own apartment buildings, you should be selling those apartment buildings right now. And fixed income. Interest rates are back up, which means bonds are getting beaten up a little bit right now. And you have some embedded near-term profits in a bond portfolio because interest rates are still below their recent highs. So if you've got a bunch of 10-year treasuries that were yielding 5% a while ago, and the price has gone up and the yield has gone down to 430 or whatever, not a bad time to bail on some of that government paper too. So there are lots of places that money could flow from and into precious metals.
So, John, let's also talk about some of the smaller gold and silver stocks then. We do follow a lot of those, and quite frankly, those some of them have started to bounce. Broadly, I've seen maybe about a 20% rise in some of these stocks, but again, those are off very low levels. What's the time frame that you look at for when some of these smaller stocks, which can move a lot more percentage-wise than the majors, when could they really get going here?
Well, the normal way that a bull market progresses is that the outside money, the generalist money starts to flow into the big names. Like if you're a normal person who doesn't really pay attention to gold mining stocks and you call your broker and say, put me in a gold mining stock, they'll put you in Newmont or Barrick or something like that. So that's where the money flows in first. And the big guys tend to outperform early on because of that. Now, this works in the precious metals market itself too, where gold goes up first and then silver picks up later. So in the miners, you would think that it would progress that way. So first the big names, and then people would say, well, who else is there? And then the mid-range names, until you're all the way down to the speculative lottery tickets. It doesn't always work that way though, because a lot of these stocks, especially right now, are so beaten down. Like you said, they're at multi-year bottoms, even though they're in a lot of cases doing really well operationally with drill results and stuff. But so if you're a 15-cent stock, doubling is just 15 cents. It's really easy to go up 100% when you're at that level to begin with. So in percentage terms, a lot of the little guys are up more than the big guys already. And they could easily, as Rick Rule says, there's a big move between hated and not hated, and that's the first step. And right now, these stocks, or until a week ago, these stocks were absolutely hated. They were absolutely disdained by most investors. And now, give them another 2 weeks like last week or like the current week, and they'll be into the range where maybe they're not hated anymore. So that might be a nice percentage gain. However, having said that, they're still risky. I don't think very many investors should be buying explorers, for instance, that haven't really already delineated an impressive resource. There are some really high quality ones that I think are good bets and still have a long way to run. But a lot of the other ones, it takes extreme expertise to understand them. So there are two ways to do it. One is you play the market. Assume that we're in a precious metals bull market now, and that the most speculative stocks are eventually going to respond to that bull market in a really dramatic way, and start buying the little guys now. That could really pay off, but it is kind of like buying a lottery ticket. So I think you're in a lot better shape, and you still have a lot of money to make with the higher quality names in precious metals. Most of your money should go there just for safety's sake. And then look at the really high quality explorers and junior miners. Pick the guys who are doing really good drilling, for instance, I-80 Gold or Dolly Varden or Snowline or somebody like that. Now, those are things you can buy because they actually exist. They've proven that they've got a bunch of gold and silver in the ground. And then depending on your risk tolerance with what money you've got left over, then look at the explorers and the junior miners that are one step down, where they haven't really proven out yet, but there's a chance that they will. So that was kind of convoluted, sorry, but just suffice to say, go for quality early on and then work your way down as you become more confident about the overall trends in this market.
Let's go a little bit more into what makes precious metal stock quality then. It sounds like you're looking a lot at these stocks that have resources, although Snowline doesn't have a resource yet, but boy, oh boy, they've had very good drill results. What are some of the characteristics that make companies stand out to you in terms of higher quality when you are doing your due diligence into precious metals equities?
Yeah, okay, so management. Very important. If at all possible, have somebody in charge of the company who's been there, done that. If they've already built and sold something like where they're currently working on, that's really reassuring. Jurisdiction. The political risk is just getting crazier and crazier out there. Mexico just announced that they might want to ban open pit mining. So that's a risk that's always been there, but it's more intense now than it has been in the past. So you just can't trust something that's in a place where there might be political turmoil, or there might be, a revolution or something like that. And then, drill results or other kinds of operational milestones that may not be all the way to where they are completed, but that are moving in the right direction with really good numbers. And there's a lot of them out there. There are, between the newfound gold types that meet most of these criteria, and a little penny stock that hasn't met any. There are a lot that are partway there. And so you want to look at what they've accomplished so far and then think about the likelihood of it continuing. And if it continues and they become a company with a resource or an actual producing mine that's profitable or something like that, then that's the goal that you're shooting for with these guys. And it takes a fair bit of expertise to be able to make that determination. That's the tricky part because companies will say anything to attract capital, and you really need to see sufficient results to give you confidence that they're going to continue and they're going to go in the right direction. So, but you know what? There's no shortage of companies like that out there. There are a lot of one of the nice things about the long grinding bear market that we've seen in junior miner space in general is that a lot of really high quality companies have kind of under the radar been able to generate the drill results that give you confidence, or otherwise, bring a mill close to production and start actually mining and producing and things like that. But their stock prices haven't gone up. So in this space, there are a lot of companies that are much more than they were 3 years ago. And yet they're not really trading for much more than they did, or they might be trading for a lot less than 3 years ago. And so I think you can build if you're risk tolerant, you can build a really interesting 5 or 10 stock portfolio in this space that, it's a potential five bagger for the whole portfolio. Even though you'll obviously have some losers in there, but the winners are going to be big winners. And so I think this is a really exciting time for somebody with risk tolerance and some expertise, like Rick Rule. Must be really enjoying this market right now because there's an awful lot of things that he understands and that are objectively very cheap. So it's an exciting time. And in Substack, I have a portfolio of exploration companies and developers and juniors, and it's been terrible. It's down by probably 30% across the board, with some of the stocks in there being down more over the last year. But in the meantime, a lot of those companies have actually gotten better. They've generated excellent drill results. They've brought mills closer to operation ability, and they've got mines that are ready to start producing. And I'm pretty optimistic about what that portfolio is going to do going forward. But at the same time, I wouldn't commit a ton of money to any individual stock in that portfolio.
Yeah, that's probably a key point right there, too. Don't necessarily go all into just one stock because they are still risky. And quite frankly, all of these stocks, even the ones that have done probably the best work, have mostly trended lower over these last 3 years. So you can spread your bets around and you have a lot of options out there because there are still quite a few precious metals equities for you to choose from. Some of these are just in a better place, I think, even just moving through this year, outside of what we are undoubtedly going to see a lot of money being raised in the sector if this continues. And to your point, John, everyone says you need to be in these stocks because they can move quickly. We haven't seen these stocks go 2, 3, 4x yet. So we've just started to see a rebound here. Maybe that is that early opportunity for a lot of investors, hopefully ones that haven't held the whole way down either. But I'm sure many of us have, unfortunately. John, thank you very much for your time. It's always great chatting with you. Thanks for spending time with us on this Easter Monday. We'll chat again in another couple weeks, and I will post a link to your Substack page below this interview. Thanks, John.
Thanks, Corey. See ya.